Hi, good afternoon, everyone. It's Terry Gardner from CJ Lawrence on Friday, March 20th, and welcome to Casa Gardner. I guess this is the new normal for a while, so we'll be producing videos on a regular basis from the new home studio. First off, hope everyone is healthy and is dealing with the circumstances best that you can. My video today might run a little bit longer than usual because, heck, where's everybody going to go? First off, I've got 4 points to my video today. First, I'd like to review the recession math that we outlined last week in our video. Second, I want to run through the policy responses from central bankers and fiscal policymakers on a global basis. Third, I want to dissect the financial crisis of 2008, 2009, and look for some parallels and some differences in our current circumstances versus that recession and market sell-off. And then fourthly, highlight a couple of emerging investable themes that are being catalyzed by the coronavirus and the circumstances we're all faced with. So first off, last week we used some recession math, some deep recession math we called it, to try to create a range for the S&P 500 based on some fundamental parameters. Clearly, that's difficult to do. We're not sure where the economy's going at this point. There's a lot of unknowns, but it's still a useful exercise to take some very conservative estimates and put some parameters around it. We did that last week and kind of came up with this range of 2,200 on the bottom with 2,700 on the top. We were trading just below 2,500 at the time on the S&P 500. So kind of 10 to 12% down, 10 to 12% up. It looks like we're kind of back around that range now. During the week, on Wednesday, the S&P 500 touched 2880 on the downside, so it didn't broach that 2200. And look, frankly, I wouldn't be surprised to see it go below that level. The market's trading on technicals and on fear and uncertainty, and so volatility will be very high, and the market is just acting on a day-to-day basis on headlines as opposed to trying to look forward at this point. But in terms of policy responses, we've seen really a very significant effort by central bankers and by policymakers on the fiscal side to create some stimulus and to create some backstop for consumers and businesses globally. The mantra of whatever it takes seems to have been taken up by a lot of governments and central banks, and we love that because whatever it takes was the motto of my old Marine Corps battalion, 1st Battalion, 4th Marines, where we would go wherever we needed to go, do whatever we needed to do to accomplish the mission. So I love to hear that policymakers are adopting that rallying cry. And in fact, we've seen it. Last week in our video, we highlighted some actions we would like to see. And just in the U.S. alone, on the central bank side, in the last few days, the Federal Reserve has cut the Fed funds target rate to a range of 0 to 25 basis points. They've slashed the discount rate by 150 basis points. They've launched a massive repo operation and have been injecting daily liquidity into the money market system. And there's more that the Fed can do and have expressed that they will do to keep the skids of the credit markets greased. They're not necessarily trying to prevent the fall of asset prices, but they are trying to make sure that the markets are operating efficiently. And with some bumps in the road and some parts of friction, for the most part, markets are generally behaving okay on the credit side. And on the fiscal side, the administration enacted the Stafford Act last week, which frees up a lot of funds in a disaster recovery scenario and gives the administration a lot of latitude to provide liquidity where it sees fit. Approved a $1.2 billion aid package. The details still are coming to the forefront. Extended tax deadlines, and in fact, given the number of policies that have been proposed and are being considered, some estimates show that what the U.S. Congress has put on the table is close to about 6% of the value of our GDP. So some very aggressive actions by the U.S. Central Bank and by the U.S. Congress, some already enacted, some on the come, to combat the expected downside to the U.S. economy. And in Europe, many of the same actions are being enacted. The ECB programs are injecting about $1.2 trillion of liquidity into the European banking system. On the fiscal side, around the globe, we've seen new stimulus packages either indicated or enacted by Germany, France, Italy, Spain, UK, Switzerland, Japan, China, Korea, India, Australia, Canada. So all of the major economies of the globe get it, understand, at least for the most part, the severity of the problem, and are doing what they can on the fiscal side to backstop their own citizens and provide some support to their economies so we can wait out the peak in the coronavirus globally. I thought it'd be useful, my third topic being a discussion or a dissection of the 2008-2009 financial crisis. Had its roots in very different places in terms of what caused it versus what caused our current circumstances. But I think it's worthwhile to kind of look at the stock market's reaction in different component parts. So if I look back to 2007, which is when the seeds of the financial crisis were really germinating, the market was actually up in 2007, so up about 3.5%. Going into 2008, the market started to become a little more volatile, and the period between the beginning of '08 and Memorial Day, the market gave that performance back and was down about 3.5%. Had some up days and down days, up weeks and down weeks, but down during that period. The summer of 2008 is when things kind of started to happen. That's when banks started to get questions about off-balance sheet activities. There were an elevated discussion about where real estate values had gone. If you remember, the mortgage brokers were pushing out mortgages as fast as they could for properties that really were believed to grow in equity in over time, and that was believed to not have the potential to reverse. Well, in fact, it did reverse. So that summer, between Memorial Day and Labor Day of 2008, the market declined 8%. And that's kind of when we started to get the seeds of, hey, there's something much bigger going on here than what meets the eye. But at the same time, there were still plenty of analysts who were suggesting that, hey, this is okay, banks are in great shape, Tier 1 capital is sufficient, and the economy is going to bounce back here, and this is a buying opportunity. Well, coming out of Labor Day of 2008, that's when things really started to change. And in my view, that's when the crisis really started to hit. That's when the panic really started to be felt. In the background, you may hear the dogs. Those are not the dogs of the Dow. Those are mine, and they're outside because they're trying to interrupt this video. But I digress. But to keep moving, so when we came out of the Labor Day of 2008, it was a short period of time before Lehman Brothers fell. Lehman Brothers fell on September 16th of '08, and that set off the crisis that the country and the globe had to endure for the next year to year and a half. So between Lehman falling on September 16th and November 20th, the S&P 500 fell 38%. That was the bulk of the fall. People take it back to 2007 because, in fact, that was the peak. But in my view, the crisis started when Lehman fell, and the market dropped 38% in the next 2 months after that. We're down 30% today. So those are the two periods of time that I'm comparing. The 2-month period after Lehman fell, and just a couple of weeks when we peaked out in February, and our market dropped. There's 38% in that one, 30% so far in this one. Interestingly enough, after the market found its footing in November, after Lehman fell 2 months ago, it actually rallied through February 16%. So the market took a fall, rallied 16% through February 9th of 2009. And then over the next month, gave that all back and more, fell 17%. So the decline was now 39% on a net basis. Okay, so and that was the bottom of the market after that big swoon down in February through March of '09. The market found its bottom on March 9th. And in fact, over the next month, rallied 27% in 1 month. So the point is, when markets find their bottoms, the snapback can really be dramatic. And there was follow through. In the next month, April 9th to May 9th, it gained another 12.5%. So the snapback was really quite dramatic. In fact, in the 1 year period following the bottom, that March 9th bottom in '09, the market gained about 60%. So it's tough to catch bottoms, but if you can catch pieces of it, there's quite a bit of return. Not suggesting that anybody should go to try to pick a bottom here, but it just goes to show you how quickly the market can move and how quickly panic can shift to become mild optimism. And on mild optimism and some visibility, markets can recover. And it's important to realize that during that period, as the market recovered, the economy wasn't recovering. In fact, the headlines were terrible during that time, during 2009. And if you remember, several of our largest banks and brokers failed, right? So we talked about Lehman Brothers fell, Bear Stearns had to be absorbed by JP Morgan, Bank of America had to come in and rescue Merrill Lynch. These were iconic names that nobody ever thought would fail. Well, they did and had to be rescued. And so it really called into question the entire financial system and whether or not we were going to have a collapse of the financial system that actually makes everything else work, right? So you can imagine, and many of you remember, the depth of panic during those days. And even iconic brands, Chrysler fell. General Motors had to be taken over by the federal government. Fannie Mae had to be rescued by the federal government, and Freddie Mac. AIG had to be taken over. We instituted programs like TARP, which was the Troubled Asset Relief Program, where the Fed had to buy non-performing assets just to try to create some liquidity in the system. The federal government created programs like Cash for Clunkers, where consumers could turn in their old cars and get cash just to try to create some cash cushion in the economy. Unemployment was skyrocketing and on its way to 10%. 10 million Americans were on their way to losing their homes. That was the headline flow as the market rallied 60%. So the market can look well ahead of those headlines once it kind of finds peak panic and max fear. So that's what we're going to be looking for now. When does the market stop going down on bad news? And that's probably where it starts to find a footing. Very difficult to pick that level, but that's what we'll be watching for. And then finally, fourth point today, some emerging investable themes that are being catalyzed by us all being home and by the coronavirus. We like to look at stocks that are benefiting from secular change, disruption, changes long-term in the economy. And there's a couple of things that are, and stocks that we like a lot that are being actually helped in terms of engagement during this period that we think will benefit over the long term. So I don't know about you, but in my house, I've got 4 kids who are all in different stages of their education, but all of them are engaged in Google Classroom right now. In fact, in New York City today, 1.1 million kids are interacting with Google Classroom. I would expect that number and the number of engagement, the level of engagement across the country with Google Classroom is going to soar as school systems, universities try to figure out how to interact with kids, how to teach kids, how to foster learning outside of a classroom environment. That is a trend that is obviously important today, but is catalyzing what's going to happen in the future. Secondly, just remote and hybrid engagement generally for enterprises, whether you're a research organization or or a municipality, employees are going to come into a process or an infrastructure now where they're going to have to be able to work on site and remotely, given whatever circumstances. I know for today's video and for operating over the next couple of weeks, right? I'm interacting with a webcam from Microsoft, using my Office 365 suite. We're backed up to the cloud. I'm using OneDrive and SharePoint. I'm interacting using all types of Microsoft products that will allow me to interact seamlessly, whether I'm now at home or in the office. Obviously, that's where things are headed in terms of employment and interaction between employees over a long-term basis. Microsoft will have a couple of tough quarters, given that product purchases will be deferred, cloud adoption may be deferred by a quarter or two, but the longer-term trends are very much in place for like a Microsoft to thrive. And thirdly, e-commerce, that's not a new theme. And in fact, there's a trade there because folks are ordering from Amazon and from Grubhub while we're all home and quarantined. So there's clearly a trade, but there's some longer term engagement that's taking place that will benefit a lot of these companies on a long-term basis. So for instance, with Amazon, hey, it's not new. We've all been ordering on Amazon for a long time, but Amazon is now increasing their user base, their customer base. They are, more customers are signing up for Prime because they realize the economics are much better. And they're expanding the amount of products that we're all buying from them. And that's likely not to go away when the coronavirus goes away. So again, increased engagement during this period leads to future growth. And that's an emerging theme that we're watching as well. Amazon's a beneficiary, but there are other companies as well. And that's what we're doing in this market volatility. We're looking for opportunities to upgrade portfolios. We're being opportunistic when we can, and we're watching to see what themes are emerging from this that have long-term legs, not just a trade, but there's real legs behind what's happening in their businesses and their sectors in the economy. Happy to take any questions should you have them. I'm reachable through my office number, 212-888-6403, whether I'm in the office or out. tgardner@cjlawrence.com if you want to hit me with an email. I hope everybody has a relaxing weekend. Turn the TV off for a little while, and we'll catch up with you next week. Thanks.